Hey, welcome back, fellow business owners. I'm Alex Glassy, business coach and business prof, and the guy who tries to make the world's most boring subjects entertaining and enlightening so that you can take your business and transform its cash flow. And that's what we're going to do today. So if you haven't seen parts 1 and 2 of this series, I suggest you go find them. It'll give you some good grounding, and then it'll lead you up to today. You'll feel much more comfortable. So go find those, and then come on back, and we'll get into number 3, which is all about how to accelerate your business's growth using cash flow. Okay, so here's the income statement again between Pat and Sam, and just as a reminder, both started off as identical businesses last year of sales of $100,000 and gross profit of 70, etc. And you can see that Pat has made a 10% improvement in sales, just naturally, just word of mouth, just doing a good job, and customers are telling other people, and in comes an additional $10,000 in sales, right? And other than that, the business just flows naturally. Pat has made no other changes. But you can see that Sam has made a bunch of changes, and we're going to go through them, right? $15,000 worth of sales, more than just the 10% word of mouth that Sam also got. Cost of goods sold, and we're not sure what's going on here because the numbers are, who can tell, but my gross margin is up by 1.59%. G&A's down, a little bit of improvement here in sales, increase in spending on sales and marketing, and a return on market spend, small improvement. How effective were those changes on cash flow? Here's how Sam did it. First of all, Sam said, well, I'm going to make a 2% increase in pricing. And so I'm going to take that $100,000 base sales, and I'm just going to add 2% of it, 2% to my prices. And that 2% just falls right to the bottom line, right into cash, right? If I sell you this pen and I raise the price by 25 cents, that 25 cents goes right into my pocket because everything else is already taken care of, right? So a 2% price increase, $2,000 improvement in cash. By the way, there's all kinds of things that you can do to improve your prices. I've even got a whole pricing course that teaches you the psychology and all kinds of techniques in order to do that, and simultaneously make your customers happy. You can actually raise your prices and make your customers even happier than they are with you. The second change that Sam made was to increase the amount of money that she spent on sales and marketing. And so you can see that she went from $30,000, added $3,000, and that $3,000 multiplied by the return on market spend equals $10,000 or $10,290 improvement, right? What the return on market spend is, just as a reminder, is every dollar I spend in sales and marketing will yield $3.43 in revenue. And so by just recognizing that her sales and marketing was effective and just increasing the amount of money she spent, she increased the amount of sales. Of course, there's still cost of goods sold to come out of that, so it doesn't all automatically flow to cash, but you can see that $10,000 less the cost of goods sold, less even the $3,000 that she spent to generate the sales, still leaves a significant improvement in bottom line cash, right? What Sam also did was improved return on market spend, right? So what Pat's got is a 3.33. What Sam has done is increase this slightly. They're doing some online campaigns, maybe, and she just tuned it up a little bit. It's easy to do. This is a tiny little change. If you're doing online stuff, you should be able to make significant changes and improvements, in particular if you're working at it and really spending some time on it, which Sam was. A little bit of change increased, created a $3,000 improvement in sales. Awesome. What else? A 1% cost of goods improvement of generated more cash of $1,253. And so I'm not sure what happened here, but just maybe a little bit of process change, just to tighten things up a little bit. Maybe canceling overtime. Maybe. There's a bunch of different things you can do here, and it's by looking at that, you can see that increased, made a 1% change in cost of goods sold. You can see that it went from 70 to 71, and then the additional 0.59% comes from the increase in price. Because when you increase the price, relatively speaking, the cost of goods sold seems to improve, right? And that's what happened here, is that the gross margin looks like it's improving from two different directions. We made an increase here, an improvement here, and we also made an improvement here on the pricing. Next change, just a tiny little thing. Again, Sam made an improvement of some kind in the general and administrative. I have no idea what it was. Tiny little change of 1%, and it generated $400, which falls right into the bank account. Chapter 2 summary. And I'm just going to go back here. I just want to reinforce this, that when you see these changes starting to be made, you can see that the difference flows into net income, and then because the accounts receivable, accounts payable, and inventory for Sam aren't sucking cash away from the business, it's leaving that change, that additional difference, that $10,093, to drop right into cash. Okay, and I want to make that change. I want to reinforce that again, right? Because Sam made decisions in the first year to minimize or free up those hidden pockets where cash kind of gets collected. It's kind of like, dust in the corner, or dust, under your bed or under your desk, right? Little places that you never think about. But those dust bunnies get bigger and bigger. And the cash that's being trapped in those areas also gets bigger and bigger. Because Sam did that in year 1, it means that in year 2, as her business is increasing, growing and accelerating, the money is not getting caught up in those dusty corners. Okay? So what that leaves Sam to do is summed up here. Those small changes, 1% here, 2% there, 2.9% here, added up to a delta, a difference of $10,093 in net income, which then dropped into cash. Different areas multiply each other. Not only do they add up, as we saw in year 1, right? Change here plus change there equals a significant change, but they multiply. She increased the amount of money she spent in sales and marketing spend. That then was multiplied by a tiny change in return on market spend. It should have, yielded $10,000 in revenue. It increased to $10,300, right? On top of that was a price change. So you just multiply all that good work in sales and marketing, and you're starting to generate more revenue there, more margin there. And then what happened is the cost of goods sold improved as well. And so the amount of sales came in, and the amount of cash was increased that fell through. All these things multiply each other. And then what Sam's going to do, I'm sure, in year 3, is take that extra cash that's flowing through and increase sales and marketing again, and increase the return on market spend again and again and again. Okay? Growth, profitability, and cash flow not only can all improve simultaneously, but should improve simultaneously. This is an important concept. And again, we've talked about how if Pat's business were to grow significantly, Pat would find that the amount of cash that was being generated could actually decrease. I mean, he's made a slight change, a difference, or slight improvement year over year. Could actually decrease because everything's getting caught up as dust bunnies under the bed, right? But if you manage your business properly, growth and profitability and cash flow should all improve simultaneously. And I think we'll see that again in year 3 when there's some even more stupendous changes taking place. All right? How's that? Thank you for watching. I hope, again, as you're thinking about your own business, you're seeing that these 5 decisions that Sam made could probably apply to your business. Think that through. Make some notes. How could it make those changes? How much money could be freed up if you did that? Start to think that way, right? And then next time, in year 3, we're going to show how Sam uses cash flow to maximize her business's long-term value, and that I'm going to show you how you can maximize cash flow to maximize the long-term value, the cash flow not only to your business, but the cash flow that lands in your personal bank account, which is awesome. And again, if you like this, if you think it could help out another business owner or entrepreneur, use that social media stuff or pick up the phone. Actually, your phone can be used to talk to people. I just realized that last week, right? Pick up the phone, talk to them, share the good news with them. Thanks a lot, and we'll see you next time.